There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Hey, Auvoria and Steve Federal here on the mic. Today is the 17th of August 2022. And here we look at the infinite screen where we can just see OBS in its constant perpetuity, I guess, right? So let's go ahead and, I wanted to kind of see, at least from an equity perspective, what has sort of developed in the markets. I know many of you trade equity-based indices on MT4, and you obviously know from at least the perspectives of what I do here First Down, as one of the managing partners, is really spent a fair amount of time in the equities markets and futures, and to a little lesser degree Forex. So essentially just more of a macro analysis is what I try to get across. But let's take a quick peek at the Forex Factory count. I know Forex Factory is my go-to place. I'm not going to get too detailed into it, but let's just go ahead and run a quick filter. I only really care about red folder events, honestly, as we could see coming in. The CPI from Canada fell in line with forecast. I was saying keep an eye on that. As far as today, this didn't come in good, did it? I mean, this is the consumer price index in the UK, so it came in hotter. The forecast was 9.3, came in at 9.4. I don't know why it's printing a 10.1 there, but that's year over year. I like to see month over month too, so just know that. So core retail sales came in higher than expected. Not as important, but later today the Fed's minutes come out, and as I've kind of indicated a little bit on Twitter, I thought maybe to sort of dial in closer than that. I think that with the Fed minutes, if you're ever wondering what it's sort of like stories that are related to the Fed minutes, you can always click on this one. It's actually in red. So take anything from Zero Hedge with a grain of salt. Okay. So because these guys are instigators. Let's take a look back. I always say to glaze through all news stories and focus on the prevailing theme really is sort of the less hawkish FOMC. I think at the same time, inflation cooling off. I think that honestly, from the standpoint of FinViz, and I'll just touch briefly on this, I always seem to go back to this area with FinViz, and a lot of it just has to do with, I just want to see stuff in the aggregate, right? I only care about daily charts here. Go to all, and then you can see a dashboard of everything that's going on. So with the exception of a few things, many commodities are down, right? These are daily charts. Each of these candles represents a single day. But the point is yes, some of them have bounced. Sugar, cotton, lumber's bounced. So's coffee, a little bit. OJ, but the long term, these things are really taking it down. I'm not seeing outside of energy, which by the way, here's the energy space right here as well. Look at us. We continue from the June highs, 120 a barrel. We've dropped damn near 20, $33 a barrel from the high. Is that right? So I mean, look at gas prices. I mean, this is bananas. Now look, this is when everything was freaking crazy. You know, as we were rising, the markets were dropping, right? At least in terms of gas compared to the S&P, which isn't obviously that accurate of an analysis, but a lot of times I'll come out with just uncorrelated comparisons, and just try to, at least from the standpoint of illustrate the mania that has really gone on. And honestly, the mania really could be pushed back to, you know, first quarter of 2000, right? So which we're already well beyond 2 years of that, but essentially there's been this disjointedness and all kinds of correlations in markets globally, right? But the prevailing theme is if the prices are going up at this time and equity prices were actually dropping, then it's really going to be different as to whether or not something like that could play out over time, right? It just seems like overkill to me, right? We were too levitated, which really represents this entire upper zone, right? Almost to the top third or the top quarter of, you know, like a 4-quarter quadrant you could break this price structure down into, was just ridiculousness. So those that shorted many of these energy prices or bought, you know, double inverse ETFs to short them in some other kind of capacity by being long, hats off to you, because it was an excellent trade. So now that prices have come down, no surprise, look, we're really holding what was a sloppy but gap up and go. See how this whole zone's kind of held here on gas, but I'm pretty sure as the numbers continue to look quite bleak, the demand for driving season and or anything that's related to petroleum and gas is just dropping, right? So from long-winded support for an answer that I just said, and I've been echoing this theme for months, I just don't see the inflation. Yes, it's showing up in the numbers, Steve. What are you, nuts? You don't see it. I just don't see it in the core underlying commodities. So eventually that's going to play itself out in, you know, a CPI metric or, you know, a whole host of others that are related to the increase in price for any goods or just the GDP as a whole, right? So I'm not going to get too much in the weeds on that, but just, you know, they're all falling. So the surprising thing to me has been, you know, gold's decline, but then again, you know, just understand that if there's, you know, there are varying degrees of leverage in different assets that are invested in by, you know, make up whatever, hedge funds, you name it, right? There's always going to be overreactions, and then what I like to call throwing the baby out with the bathwater, which has pretty much happened in almost all areas, including the equity markets. So what can you glean from that? Well, then just understanding what's sort of going on core commodity price wise. The only thing you can really glean from that, from a trader perspective, is the things are nutty, right? And maybe I've probably spent too much time sort of trying to push that narrative forward of nuttiness, but it really has kept my hands, honestly, on the macro pulse, and that's, you know, we were oversold. I've said we would probably see a huge bounce in equities. We have. Now I have no idea where we're going from here, right? We could go back down. My max pain theory for equities is we will probably rip to the point where the bears are like, this is unbelievable. I thought we were truly in a bear market. I've had it, right? And they close all their short positions or whatever type of leverage they have related to their negative stance. And then that's it. That's when we start falling again, right? That's the way markets happen. So whether it's the Forex market, which I'm going to go to next, and, you know, honestly, after the dollar's rise into, let's call it the safe haven trade that really lifted this up by almost 5 full points through mid-June into the middle of July, I think this was just, for lack of any other description, it was a flight to safety. You know, and now that's coming back, and hell, we're still, as I had expected us would be, somewhere in the thick of just trading in this particular zone, right? So if you're looking at a daily chart from about right here to about right here is what I would consider to be the zone that we'll be trading in. I think all bets are off if we drop to under 104 to a large degree, right? Why? Because it is the true support line at the bottom of this lower range. Notice I'm using a range that is from the breakout. This is a cup of handle breakout, by the way. And notice how the top part of the handle, maybe even slightly under, is act as support in this particular zone. So, but looking at everything that's kind of come into play on all this, I think that this will probably act as support, and who knows, maybe go back up and test the top of this range. But I'm betting for, I always suggest you look at the dollar first, and you can use it as the pin action for other areas, but I would suggest looking at the dollar first. And then you can take a look at all the other currencies, of which I'm just doing a bigger picture at. I'm looking at it here as I choke on myself today. All right. So dollar stuck in sideways trade, building out a base. Euro, obviously down towards the lower part. Same thing with the pound. Albeit the pound hasn't been as weak, so. Craziness in the New Zealand markets. What else did I want to address? So, actually, let me log in here. For those of you not familiar with what this is LastPass. It is a vault. I have a ton of stuff in LastPass. And we're going to see if I can find this. It's a pretty good stat. God help us on this Inflation Reduction Act, which is just more of a piece of shit reduction act. I should say an increase in the BS act. I hope I'm wrong and it actually does some good, but we don't really see that. There's a Markets Insider piece that I posted. And where is the... I think... Let's see if I can find this real quick. I may have taken a screenshot of this. See if... Yeah, here we go. So I can just, yeah, here I can bring this one in. This is pretty cool. This is the Chrome browser, so disregard all of my corporate logins here at the top. So the key with any bear market rally, and maybe you know what I should do? I don't follow. I really should follow this guy. No, sorry guys, I am unprepared. But let's just do a search for this guy instead. I think that would probably be better from an illustration standpoint. So this guy's at Berg Milton. The phone's ringing off the hook here, first down. So at Berg, it's actually a good guy to follow. Here he is. This guy's pretty smart CFA. So I'm going to show this thread. So it says basically if this were a bear market rally and the S&P 500 gain of 17, which is less today. Obviously, markets are down, but a gain of 17 off of yesterday, off of a decline of 23.5. And remember that this was the most the S&P was down this year at the worst, and then obviously it had a rally back, if you may recall, to finish off at the end of that day at this point. So with a plus 17% rally off of the bottom of essentially would be the greatest bear market rally after an interim bear decline, okay? So it doesn't mean that, this guy's proven right and I'm wrong, or who's... The point I just want you to understand in any type of analysis I do is really just the magnitude of moves and sort of like lifting the cover, as I always try to explain, and looking under what's going on, right? So if this were a bear market, and this would be the first time that a 5-week advanced decline, that's what that spells, right, that exceeded 1.9 to 1 in a bear. So he's seeing the internals, and there's a whole bunch of things that you can look here, and maybe I should just post his follow on Telegram, right? I think I can do that. I know that Bill and the team have shut down a lot of telegrams. Let me see if I can post this. Actually, no, it's still showing up. That's cool. Alright, so I'm going to paste this into the Telegram. You guys will have a good guy to follow if you want to see these stats. Looks like it wants to paste. Oh, here we go. Good follow. Point is that if he's right, we have a big rally in our hands, which is kind of what I've been talking a lot about over the course of a period of time. But as I was sort of talking about it, and it really isn't about Steve Vetteral's ability to be right or wrong. It really, because I've often thought I was probably more wrong than not. This was really just a hunch, not rooted in any solid research, but I have been proven right off of this bounce in the bottom, to the point where a whole bunch of new clients that came in with equities or portfolios that were real heavy at equities experienced significant bounce off the bottom, as we're illustrating here. We've lightened up the equity exposure. So, do we go back down to the bottom? Do we continue rallying to new highs or to the highs? If we rally to the highs, that absolutely would be the max pain trade, and that's really the only point I'm trying to make. So if in fact we went back down to the bottom, then that would necessarily surprise the vast majority of market participants, bull or bear, right? So the markets have a tendency to try and surprise the most of the time, right? And that's what I call max pain. And essentially, it's what would they enjoy, in terms of the maximum amount of, what would be the pain that would hurt the most, right? And that would be new highs. So for those that were long, they would disagree with that, right? In terms of equity land, but for those that are short, that is max pain. So you can read up on that. I posted on Telegram. And let's see. I think that's pretty much all I wanted to chat about today. Just keep it. I wanted to kind of see, maybe I should have waited for the Fed minutes to come out. Typically with the last 2 weeks in August, yes, there are some school systems in the United States that are back in action, like Florida here. But many school systems, they're not back yet. So I still think we got that summer doldrums, sort of like, not as much volume going on type thing. And if we jump back over into the broad markets and just look at the spiders, right? This particular instrument is one of the most traded on the planet outside of the Forex markets, and see how volumes have declined, right? And that's sort of that summer doldrum. The volumes aren't near where they were during the craziest. They're less than half, right? Is to be expected, right? The others that will see these declining volumes and see this will tell you, well, hell, once everybody gets back in action, all the big portfolio managers get back in the helm, which is typically the first week of September till, obviously the end of the year, they're going to pull this all the way back down. Hey, that could be right. I don't think max pain's a pullback. I think max pain is somewhere up around this zone for you looking to trade long term. But for right now, we've come a long way. This should be digested in some form. So we had a reversal yesterday. By the way, just for those of you that, and it happens, it's okay. The beauty of doubting Thomas's, actually, let me just go back. I messed up the data here. Here we go. So if you take a look at this period of time, which essentially is the last little bit of December into 22, okay? I try to look, near a full year. But in terms of data, I like to pull from what's called a VWAP, which is a volume weighted average price. And oftentimes markets will move based on, current lows. Some of these people call them fractals, what have you. It doesn't really matter. The point is that a lot of decent analysis can start from some of these fractal-based pullbacks, especially right here, whether you're doing fib analysis or whatever. But the rally that ensued in the equity markets, as being the S&P 500, look where it stopped and reversed. This is the point of control right here. This POC line is an aggregated center point or center line. Some people call it a naked POC, some people call it a point of control center. Doesn't matter what you call it. It's where most of the volume is executed on the S&P 500 spiders since essentially 9 months ago, right? So these points can oftentimes completely stop and halt even the most powerful progression upwards, like we've certainly seen, with barely any cooling off since this pivot on the 14th of July, right? Regardless of what market I am putting this analysis on, you can always use the same type of analysis on any chart, right? I'm just using this one to illustrate a particular point in technical land, but you can, you can overlay the same strategy on a Forex chart if you want. It could be any currency or that you trade, but the point is that we had a recent low, fractal-based print, right? We've completely had a massive lift since then, which for at least 5 days of almost one time framing up, we've got a reversal and reverse the key point. Now, that was also a big time moving average there too. So as this is almost a perfect illustration of what's called confluence, meaning that different types of factors in technical land, in this case moving averages and a POC from a market profile chart, have both intersected at the same place. And there's probably a bunch of other stuff that dials in around here, right? It could be some fib retraces or whatever. But the point is, the more there is in things that intersect or align and become areas of confluence, essentially where lots of important stuff intersect, right? These are typically turning points for either a pause, and a sideways trade, or a complete reversal, right? So that is my lesson for the Auvoria community. I wish everybody a great trading week. As always, send me your questions on anything you may have. I do know that I think at some point, maybe today or tomorrow, I do have a chat scheduled just to see kind of what's going on with some requests that have been made. They've suggested that I make a video for 1 minute on why not to trade, which maybe they took a cue from some of the videos I used to show in the old days, because when I was a mentor, this was many, many years ago, I still have a lot of the videos up on YouTube to sort of explain all that. Some of it's getting a bit dated though. But when I was a mentor, I spent most of my time talking people out of learning to trade the futures markets versus, wanting to get into develop a mentoring relationship with whatever expert, right? The other video will be 1 minute on why to trade. And, it's going to be just a quick discussion of both. So I'm probably just going to shoot the videos in the office here, turn on the camera, put my smiling and good face in front of the camera, and give some hardcore thoughts and processes to that. But I'll be talking hopefully later today with Matt Ward. He's the president of Auvoria. Maybe we can try and get some ideas going on all that. So I bid everybody adieu. Have a great week.